folks, and welcome to a Check on Chain update for the 21st of May. Well, Bitcoin's back on the move. We've rallied back above $71,000, really showing quite a bit of strength after coming off about a 2-month long consolidation, maybe even a bit longer than that. So it's really had quite a bit of time to digest this move. I wouldn't be surprised if we still chop around for a little bit more, but at the same time, I would equally not be surprised if Bitcoin takes another shot at the all-time high. So some pretty remarkable price action. And today we're going to be diving into what has really been going on under the hood. Now, as a bit of a heads up, we've actually just crossed our first month anniversary here at Check on Chain. So we've actually only been writing about this particular consolidation. It's kind of been our world. Now, these, like with anything in Bitcoin, it feels like it's taken, years to go through this process, but at the same time, time absolutely flies. So a bit of both. And what we're going to be doing in this session is covering some of the key metrics that we've had our eye on, some of the key concepts that we've been paying attention to over the course of the last month, and really essentially doing a big review and saying, well, all of these metrics we looked at, where are they today? Where are the key insights that we were looking at over the last couple of weeks? And where does that bring us to, how do we get to 71,000 and really the underlying market strength of how we get here? So for this particular episode, in both our Substack and YouTube, both will be available for free. So if you're actually interested in seeing what we're doing over there at Check on Chain, you want to get a bit of a feel for the kind of analysis content, this is probably a really good piece to go and actually have a read, because it's a bit of a review of all the other pieces we've looked at, the key metrics, the key concepts, and really rounding it out and, doing a bit of self-reflection. So what we're going to do today is cover those key indicators, the key concepts, and there's also a couple of key lessons that I actually learned, right? As an analyst, I'm constantly growing and learning new things. So we'll cover some of those key insights towards the end of the session. Now, if you are watching it on YouTube, please do give us a like, a share, and a subscribe. It helps the channel get to more people. It helps the algorithm, all that good stuff. And I would recommend that people jump over to our Substack if you haven't seen it before, so you can actually have a read and go in a bit more detail alongside this video, just so you can see what we're doing over there. But anyway, without further ado, let's get stuck into the analysis. All right, so let's start with a bit of a fun chart just to paint the picture of where we currently are. This is looking at how many profitable days versus unprofitable days. So on a closing basis, how many days has Bitcoin closed at a higher price than where we currently are? And the answer is not many, only 8. Out of all of Bitcoin's history, only 8 days have been at a higher closing price. So we're in pretty much, very, very thin air up here. There's really not that many instances above here. Now, the other thing is that there's not many coins that actually have their cost basis still up in this top level. We'll cover that more towards the end of this episode, but in many ways, we are on the cusp of price discovery, and we're very close to a thing that I guess you could call supply discovery. There's just not that many, there's not many coins with a high cost basis. So in that regard, there's not that many people who are going to be sensitive and saying, you know what, give me my money back, right? So we're in this very interesting dynamic where we are on the cusp of that new all-time high break. And, it really only took about a week to fully reverse most of the damage done during this correction. So really quite astounding, but at the same time, a very, very strong, healthy, well-structured consolidation that we've been looking at over the last couple of weeks. Now, we actually set our deepest correction, 20.4%. Let's put one on the board for the bears. They have really, really struggled to get Bitcoin's price down. Now, this purple zone here is literally the corrections. Now, before I forget, let's move myself up here. This purple zone is actually picking up all the corrections since the FTX lows. So if you can believe it, and if you survived the nastiness of 2022, we've only had a 20.4% correction, and this, quite frankly, pales in comparison to most other bull markets. It's kind of closely aligned with the 2021 bull, but at the same time, 2021 was just straight up. It was vertical. There was basically no rest along the way. We really only had one major correction, right? 25.5. This has been a very, very structured market. We covered this a lot in the quiet and trending piece, which I think is actually very, very much in play. And to be honest, there's a lot more similarities between 2016 and 17 to, relative to 2021. I would certainly put it more into this spot-driven type market. Even just the profile of this looks a lot more like this, albeit without the depth. So really quite extraordinary. This chart continues to amaze me. It really does blow my mind that we haven't even taken a 20% hit really at the end of the day. I think that really is a sign of strength and a sign of quite literally support underneath. Now, the Euphoria zone is an interesting concept. Now, if you've been following this channel for a while, you've probably heard me talk about this. The green zones here is essentially highlighting when we break to a new all-time high, right? That's kind of the very vanilla gauge for this. It's looking at over a 30-day period, so it'll turn off and on. But generally speaking, once we're up at in price discovery, let's call it, we tend to stay there and the market tends to trend pretty strongly. Now, you can also see, just look at it in terms of a gradient. The 2016 market was kind of this slow, sloping, gradual move higher. And once we broke to all-time highs, it started to go parabolic. We can kind of see this again here in 2020. It was kind of this stair-stepping, quiet and trending market. And then things get pretty euphoric and vertical as we get above the all-time high. I would characterize where we currently are as on the cusp. We haven't quite broken into the same level of euphoria. We've kind of toyed with it. We're on the edge of it. We're still on that boundary of excitement and euphoria, but we haven't quite really gotten to that next level, right? It hasn't leveled up into that full-scale euphoria. Now, down the bottom here, we've got the MVRV ratio. I just want to just look at the character of how this thing trades. Notice in 2016, we kind of get these rallies and it pulls back, and the amplitude of these moves is fairly consistent the whole way through. Notice how 2017, the amplitude changes significantly. It starts to really get volatile. Now, remember the MVRV, it's the same in 2021, by the way. We get this kind of lower amplitude and then euphoria, things get pretty wild. Now, MVRV is actually the unrealized profit or loss held by holders. So volatility in MVRV is actually telling you that people are going from in profit, having a great time, to not so in profit, having a kind of a nasty time. Some people are still in the green, so away we go again. And eventually it chops around until it finally caves in and we get this top heaviness. Price pulls back and lots of people suddenly fall from having a great time in profit, not so great time, not so much in profit. Now, also note that that euphoria, that all-time high break, generally aligns with getting to MVRV of +1 standard deviation. It's basically saying that statistically speaking, they're in a decent amount of profit. Now, the reason why it actually takes time, we tried to get above the all-time high twice, and it took 3 attempts back here in 2016-17. We kind of chopped around for a while in 2020 for most of November and December until we finally got through. We've kind of done the same. In many ways, it takes time to get above this level. And there's a few reasons for this. All-time highs attract buyers. It also attracts sellers because the sellers know that there's buyers coming in, and you need that demand side liquidity to actually take bigger positions off the table. If you're a very large seller, you need lots of people to buy and be wrong. That's kind of the nature of the beast. But also lots of holders are in a meaningful amount of profit. MVRV of 2.6 basically means that everyone's at about 160% profit on average. So it makes sense that we actually bump our head here, and it takes time, and the market's got to absorb that sell side. And that's a process, which is why all-time high breaks, they're not a one and done thing. They take time to actually process and make it through to the other side. So the fact that we're kind of getting up towards that level again is telling us that we're actually in this, this chopping wood phase, and it's really going to see whether we can bust through that level and move into this higher amplitude. Quiet and trending down here, volatile and trending higher up. Now, in one of our pieces called Expecting Chop Solidation, which is definitely still one high probability outcome, which is that we just have weeks to months of chopping around still within this range, still absolutely within the realm of possibilities. But in that piece, we said that there just hadn't been that second wave of demand come through just yet. And the ETFs are actually a great way to look at that and really visualize it. We saw a huge amount of demand, obviously in the early days. It weakened through March and April, which was pretty much the majority of our consolidation. We had that sell off to 57K, which had a little bit of a micro capitulation. And we've actually moved back into a period of inflows. We had 4 consistent weeks of worsening total outflows. There's about $1.1 billion in total outflows over this month. But then we've actually had 1, 2, 3, and this 3 is actually only Monday. And what we've actually seen is 1.2 billion flow in over the last, well, it's not even 2 weeks, really. It's 1 week and 3 or 4 days. So pretty astounding stuff, right? The 4 weeks of outflows have been 100% reversed over the course of just a handful of days. So it shows how things can change and shift and move very quickly. But it also shows that all this buy side is hitting a thinner order book. Yes, there was a bunch of sell side, but this has been absorbed by other people. Those coins have been taken off the market because the ETFs must sell them. So those coins got bought by somebody. And then there just weren't as many coins on the books to get us from, 57 all the way up to 71 over the course of just a couple of weeks. So it really shows how things can change very quickly. This is why Bitcoin's volatility, it's a double-edged sword. It can move in both directions. And, very, very thin liquidity means that it almost teleports, right? It feels like last week we're at 60K. This week we're up above 70. Now, one thing that's important to track, and this is actually a new chart, so we didn't cover this in our previous reports. This is a bit of an insight here. NVT is Willy Woo developed this NVT price model, and what it's trying to do is take on-chain throughput. If we think about it, right, let's go to the extremes because that informs the mean. If you have no one using Bitcoin and there's no transaction throughput, it's kind of hard to paint a very bullish case. Conversely, if lots of people are transacting and there's lots of volume flowing through the network, it's probably much better, right? That's generally a good sign. So what this particular model does, it uses 4 different types of transaction volume. There's one which is coin block, which I won't go into the full details for courtesy of time, but it's time and volume weighted. Coin days are involved. We've also got exchange activity in the red, and then we've got 2 different measurements of filtered and unfiltered transaction volume in the green and blue. The short story of this is it's trying to impute a bit of a fair value. Where should Bitcoin be based on the amount of throughput that's happening? And if we look at it from that perspective, there's a couple of zones. Down here at the early phase, again, when we're breaking the all-time high, notice that all these price models clustered around the spot price, meaning we're at fair value. We're at the right place. We're not too hot. We're not too cold. We're kind of exactly where we need to be. 2020, much the same. We had a bit of a clustering where all these price models came together. We don't have this same kind of dispersion and some stuff's moving up and down and it's chopping around. That's generally bull market behavior. During the early phase of a bull, we're kind of at the exact level we want to be at. And more or less, that's where we are. We've seen all of these models converge to where Bitcoin's price currently is. So in that regard, it doesn't feel like we're too hot, doesn't feel like we're too cold. In many ways, we're kind of exactly where we need to be. And generally speaking, we see this during these earlier phases of a bull, this quiet and trending environment. Now, what's important is that as the price rises, we do need to see that volume follow through. So this price model, let's say price rallies higher and these models actually curl over, that would be telling us that the transaction throughput is actually not supporting the move. So it's a bit of a fundamental check on, do we actually see price and volume uptick accordingly? Because if not, it can be a bit of a divergence, right? And you can sometimes have these periods where you've got the fundamentals are declining. Price will generally start to find some kind of a ceiling. And you can actually see it here in 2017. The fundamentals were decaying pretty nastily and price eventually had to come down and meet those levels, right? So it's just one of those things to pay attention to. But right now, everything seems to be almost exactly where it should be based on this particular model. Now, a very quick snapshot on the derivatives. So one thing that's been very interesting about derivatives and just general derivative market structure is we haven't seen this massive cratering. This is the funding rate. Notice how when we sold off here in May 2021, it got really, really nasty, really, really quickly. This is basically a deleveraging. People got force closed out of their position. We went from a period of high funding to negative funding, which means that shorts are paying longs. This is a wipeout of leverage, a deleveraging, nasty margin call, not what we want to see. We haven't seen anything even close to that, right? These tiny little spikes down here, basically nothing. This is a natural deleveraging. The market essentially kind of cleared that leverage by itself. It wasn't done with any kind of major forced selling. We saw a couple of periods where that open interest closed very quickly, but nothing that was a margin call. We didn't see a giant margin call. And the overall futures position is much, much healthier. A lot of the futures that are actually not perpetuals, but a lot of the futures now actually on the CME, so more regulated exchanges, we've seen a real cleaning up of the leverage picture. We don't have the same kind of really ugly story that we had back in 2021. It's been much more controlled, much healthier. Really, I mean, it's exactly what you want to see. Now, something else that's pretty interesting is we still have people betting against this rally. So one of the, I guess the market components that I've always carried with me and, learnt over the years, when everybody's on the same side of the boat, it generally means that everyone's about to be very, very wrong. So what we're looking at here is the liquidation dominance. When it's green and it's a higher level of green, that means that the majority of people being liquidated were levered long. When it's red, it means the majority of people were levered to the short side. Now, another thing to be kind of just reference here, generally speaking, if you're a sophisticated market actor and you're doing some kind of arbitrage strategy or a cash and carry or a yield capture, you're probably not going to get liquidated because you've got a short position over here, you've got a long position over here, you're balancing your risks, you're managing things. So sophisticated actors usually don't get liquidated. It's usually the not so sophisticated actors that are dominating liquidations. And right now, and in fact, for the majority of this rally, right, since before the ETFs launched in October last year, pretty much the whole way up, shorts have been getting liquidated left, right, and center. And this move higher is no different. Shorts continue to dominate the liquidations. And that's telling me that people are still betting against this rally. Now, again, this is not the only indicator, but it's certainly going to help the bulls, right? When you got a bunch of shorts who are on the wrong side of the boat, they're getting squeezed. And ironically enough, these very, very few periods when we've seen longs get too excited has generally been a local peak, right? You get kind of too many people betting high, and then we wipe them out on the way back down. So it is very interesting that lots and lots of people are still betting against this uptrend, right? Despite the fact it's one of the most structured uptrends we've seen in a long time. Now, let me just go back over here to 2021 just to refresh our memory. During the 2021 peak, both of them, longs were the ones getting liquidated. So an all-time high looks like everybody saying this has no ceiling. Bitcoin only goes up. I cannot lose. Levered long. It's usually when everyone's on the wrong side of the boat. So, and notice here, as we rallied higher in September and October, same thing. We had all of these short positions getting squeezed all the way into the all-time high. Then they decided, okay, we're now at $69,000. Now's the time. I'm giving up on my shorts, full long, wiped out for the next year. So it's just kind of the nature of the beast, just an interesting insight that when lots of people are on the wrong side of the boat, market tends to squeeze them in the other direction. Interestingly, we're seeing a very similar pattern within the spot market. So here we're looking at cumulative volume delta. In other words, it's all the market buys and sells. So it's netting off buying and selling. It's basically looking at the net. Take all the market buys, right? This is actually net market buying. This is net market selling. So we're still seeing people market selling into this rally, despite the fact that it keeps pushing higher. And to me, this really speaks in 2023. It feels like a more patient buyer is sitting down there, just letting themselves get filled. The overall support, I mean, the fact that we haven't even given back a 20% correction so far, and you've had predominantly spot market selling, tells me there's just someone there just absorbing that supply. Just, the market buy side is really, it's only been the ETFs on the way higher. It's been predominantly market sells. They're just allowing themselves to get filled. That's my my big picture read coming off this. Okay, so one of the big components that we've been covering at Check Onchain has been this concept of being top heavy. Now, top heavy, to really just summarize and break down what that means, too many buyers buying too many coins at too high of a price. And when the price falls out from under them, they panic, right? And once they panic, we start to move into a regime where bear markets become much more likely. So this here is looking at the overall supply and loss up here in these area charts. We've got supply and profit as an oscillator down the bottom, and we've got supply and loss up the top here. Now, very, very high level, you can see these regular garden variety corrections. We often get supply going into a loss, right? Very, very normal. Someone's got to buy the top, market sells off, they go into a loss, but it's not this. This is top heaviness. Lots and lots of supply going into a loss. This is where people go, oh man, not only am I wrong, but like it's over. I'm done. I'm out. And you can see how supply and profit decays really, really nasty during these bear markets. In our current environment, this again, much like our drawdown chart, the amount of supply that goes into a loss on each of these corrections feels a lot more like uptrends. We haven't seen that just unbelievable decline where the worse it gets, the worse it gets, right? The more the price goes down, the worse it gets. We haven't really seen that. And in fact, we've recovered from this level in a way that looks just like most of our previous bull market corrections. So far, in terms of this mechanic, looks pretty good. And the other thing to note is how much this has recovered from 82% supply and profit up to almost 95. So we've seen almost every coin go back into the green, which also tells us that lots of people sold low and their coins have now gone to a new buyer who's at a much more favorable cost basis. The market rallies, takes those coins back into profit. So overall, the dip buyers have in fact stepped in and they're now sitting very pretty. Now, this is a chart that we opened up with, and I think it's quite an important one. Here's our short-term holder supply in orange, and then we've got the short-term holder supply in loss down here in red. Now, maybe just a little bit hard to see, but actually this trace is now currently down here at 322,000 Bitcoin out of a total of 4.85 million. Now, they got up to 3.3 million Bitcoin, and we're about to touch on probably the biggest lesson that I personally, as an analyst, this is really what I took away from this entire process, probably the biggest lesson, right? In terms of analytical things that I just was processing and kind of came to a new conclusion, this is really the one that stood out to me. Now, we can see these garden variety corrections. Again, during bull markets, we get these periods where, short-term holders go into loss. Top heaviness is when too many people go into loss. Now, we didn't actually flag our full top heaviness condition up here, right? +1 standard deviation. We didn't get there, but I'll tell you what, we got close. We had a bunch of warning signs lighting up. But just because a coin is in loss doesn't mean it's in loss by a lot, right? There's a difference between binary in profit, in loss, and the magnitude by how much. Because if someone bought a coin at 73,000 and we're down at 60, they're going to be in loss. If someone bought at 60,100 and we're at 60, they're also in loss. But are they the same? Not really. The guy who bought at 73,000 is in a way worse position. His red number in his portfolio every time he checks is considerably worse than the guy who bought $100 above the current price. So in that regard, it's important to look at both the supply in profit or loss, but as we kind of evolved our thinking, so let's jump to this one. Here, this is the magnitude, how much of their supply in terms of dollar value was actually in loss. And in many ways, it just ain't that much. So when we're looking at the short-term holder supply and loss, yes, there's a lot of them. 2/3 of all coins were actually in loss by the short-term holders. But the magnitude, you got to squint to see it. So it just wasn't that severe. And I think that's a really, really important distinction. And it's certainly one of the things that I took away is combining this binary in profit, in loss, but also looking at it in terms of by what magnitude. Is it enough to be concerned? Because it may not be. If it's a couple of percent, don't worry about it. Now, just to jump back to this one, this is looking at short-term supply in profit. Here's probably the most important thing. We've seen this enormous, as I said, 33%. So only 33% of short-term holder coins were in profit, which also means that 67%, 2/3 of all short-term supply, was acquired at a cost basis above where the spot price was. We tested conviction. We really tested a lot of people who didn't sell. Now, a lot of people did sell because this massive recovery, we're literally up at 93.3% of supply and profit. We're pretty much back towards the highs. This recovery over the course of barely a week is telling you that a lot of people who bought high sold low. Those coins went from in loss to some other guy, price rallied, and that other guy was fortunate enough to have bought the correct dip, right? So what that also does is it reinforces that short-term holder buying behavior. We have moved from a regime of sellers during rips to buyers during dips. And we see this across many metrics. We've covered this quite a bit at Check Onchain. We've looked at things like SOPA and MVRV, which we'll look at in a second. A whole lot of metrics have transitioned from, the bearish case, which is selling rips, give me my money back, to buying dips. And they continue to do that behavior more or less until they don't. So we've got to keep tracking to see when that actually flips over, because it will. Eventually, it will flip in the other direction where it goes from we are buying dips to we are now selling rips. That will happen. But it usually comes after a really nasty sell-off, something that just breaks sentiment. And that's why we were looking so much at this top heaviness concept, because that is going to tell you when sentiment has broken. You need a lot of people to get really wrecked really quickly. And that's usually what breaks sentiment. And that just becomes unrecoverable. So just to really get towards the end of this, short-term MVRV, really it's one of the most powerful on-chain tools. You'll see me refer to this all the time. Now in our quiet and trending piece, we were looking at different types of market structure, and I alluded to this earlier with MVRV. It's got these kind of different amplitudes or resonant frequencies. If we look at things with short-term MVRV, notice in the early phase of a bull, we typically oscillate. We get to about 1.2, sometimes a little bit above, but only a 20% premium to the short-term cost basis. Once we get into this higher euphoric phase, we really get above that, right? Plus 1.4, 1.6. We start to get to much larger premiums from the short-term holder cost basis. For almost the entirety of 2023, with only a handful of very brief exceptions, we are very much in this quiet and trending. We get to 1.2, that's usually enough. Sometimes we get to 1.4, but then we pull back. We're still within this quiet and trending, very stable, very structured. We're not getting to any kind of crazy extremes. The market's not just ripping to the upside. And, the short-term holder cost base is allowing itself. The market's coming up and it's retesting that level regularly. This is, well, uptrend bull market behavior. This is what I mean by bear market behavior. People are selling their cost bases. The market comes back to their level. Give me my money back. Get me out of this thing at any price. Comes back up. Get me out. I'm done. Now we've moved to, that's my cost basis. I'll step in. That's my cost basis. I'll step in. This is generally speaking what we see during uptrends is people are actually stepping in and buying their cost basis because they see value. They don't see risk. It's kind of this inversion of how investors tend to behave. And, thus far, we've got a quiet and trending market structure and we continue to find support. Overall, in my view, it actually looks pretty strong and pretty sound at this point. And the last one that we're going to touch on is a momentum indicator, very much in that same ballpark as MVRV. This we're looking at over a 90-day period. Higher values of this indicator essentially means the market's getting increasingly vertical relative to the true capital flows as measured by the realized price, or in this case, the true market mean. Now, for whatever reason, 90 days is about the sweet spot when it comes to bull market corrections. It's just long enough to convince people that it's over, but it's not long enough to convince everybody that it's over. It's kind of just the right amount of time. And what this is basically saying is that over a 90-day period, we came down and actually retested this level and have since found support. Now, we find this quite regularly during uptrends. You can see the 90-day quite often finds support in and around this level. And it's showing you that over a 90-day period, the market came back, entered neutral momentum, and then started to move up once again. So seeing a retest here, again, if we just kind of peel back all the different layers and say, what would we expect to see during an uptrend? We would expect to see support getting found at this level. It's a very typical level for that to happen. Yes, there's instances where we break below, but generally speaking, we should find support there. It's periods when we don't that things start to look a little bit more dire, right? When we actually come back and retest from the other direction, that's when things aren't okay. At this point in time, I would put this into the bucket of so far, so good. Keep an eye on it, but so far we have not seen that kind of major break below. And in many ways, it's kind of what you would expect to see during an uptrend. So, so far, so good. Righto, folks, thank you so much for tuning in for that session. Hopefully you found it useful. Really at the end of the day, negative momentum just hasn't really formed. We haven't even seen the bulls take us down below a 20% correction. We didn't see top heaviness eventuate. We saw it start to get very close on a supply and loss dynamic, but not on a magnitude. We just didn't see the magnitude between where people had bought and where the price actually got down to. It never quite eventuated to really manifest into a much deeper and larger correction. It's possible that we're seeing that second wave of demand start to develop, certainly ETFs, but paying a bit of attention to that to see whether we get that follow through. And also in the NVT price models, we want to make sure that we actually get a follow through in the overall transaction throughput. And overall, as it stands, 2023 and 24, it still feels like it's in a quiet and trending market environment, which overall is constructive, right? It's what we want to see. And, as I said before, so far, so good. So thank you so much for tuning in, and I'll catch you in the next one, folks. Cheers.